Fundamental factors are once again shaping market trends. And today it became known that manufacturing activity in China, the world's largest energy importer, unexpectedly contracted. As a result, oil prices resumed losses. Besides, crude prices came under pressure from easing tensions between Israel and Palestine, which dampened fears that the war could grow into a wider Middle East conflict. Nevertheless, Tel Aviv still plans to launch an expanded ground operation in the Gaza Strip, which could lead to a sharp increase in tensions in the world's largest oil-producing region. So, oil still has a chance of rallying up to $100 per barrel. In the meantime, an inverse correlation between the dollar and other instruments remains strong. A steep rise in the greenback has brought crude prices down to a one-month low of $85 per barrel, and thus the influence of the US currency is stronger than that of geopolitical risks. Speaking of the long-term prospects, it's also worth reassessing the balance of supply and demand. Traders take into account statistics on the US economy and the world's largest oil consumer. Industry data show that oil inventories are growing at a moderate pace, which could threaten energy shortages with a subsequent rise in prices. So, the current decline in oil prices is probably a temporary phenomenon. Meanwhile, gold remains stable. Despite apparent volatility, the yellow metal has been trading at around $1,980 per troy ounce for more than a week now, and this reflects uncertainty amid global risks, particularly the ongoing Palestinian-Israeli war. Investors fear that the United States could be directly involved in the conflict, and the situation is still extremely explosive and may spin out of control at any moment. Thus, geopolitical factors are still the key driving force for gold prices. As for the ruble, the Russian central bank's further monetary policy tightening seems to have no effect. The US dollar continues to trade above 90 rubles. Friday's meeting has made no difference either. This is not surprising, as there is a growing consensus that the current policy of Russian monetary authorities, aimed largely at stabilizing the currency market, has a devastating impact on the economy, thus leading to the opposite effect. Against this background, the ruble remains under pressure, which paves the way for the greenback's rally to 100 rubles. That's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.